Good morning and thanks for joining this press conference with Lyxor Asset Management. The European green bond market is poised to enter a new phase of expansion. It's driven by the increasing role of sovereign issuers who are making a huge effort as economies recover post-COVID. The EU has signalled that green and sustainable investments are going to play a central role in its next generation stimulus plan. And in this context, sovereign green bonds are set to become a major driver of growth for the wider bond market. Lyxor Asset Management, which launched the world's first green bond ETF in 2017, is a pioneer in this market. And this week, Lyxor listed the Lyxor Euro Government Green Bond ETF. It's the world's first ETF tracking sovereign Eurozone green bonds. Today's webcast will explore the expansion of this segment and look at how green sovereign bonds, or Govies, can be harnessed with ETFs. I'm joined today by Sean Kidney, who's CEO of the Climate Bonds Initiative, who's going to talk about this expansion from the perspective of issuers. Hello, Sean. Thanks for being with us today.
Thanks for having me.
Also joined by Francois Millet. Francois is head of ETF Strategy, ESG and Innovation at Lyxor Asset Management, and he's going to talk about the opportunities of green bonds from the perspective of investors. Hello, Francois. Nice to have you with us today.
Hello, good morning. Good morning, Tony. Good morning, Sean and Philippe.
We are also joined by Philippe Bache. Philippe is head of Fixed Income ETF products at Lyxor Asset Management. And he's going to talk to us about Govies from a product perspective and how these products can help investors make the most of this growing segment. Good morning, Philippe.
Good morning. Good morning, everybody. Thank you.
Before we begin, you can put your questions to the speakers in their chat box at the side of the YouTube window. You do have to sign in to YouTube in order to be able to do that. If you would like to send through your questions by email, you can send them through to me at my email address, which is tony.todd@rumeurpublique.fr. I'll make sure that that email address comes up on the screen throughout this press conference. So let's begin. If we start with Sean Kidney, CEO of the Climate Bonds Initiative. Sean, sovereign bonds have developed as a key driver for the green bond market. For you, what are the most interesting developments that you've seen on this market in recent months and years?
Oh, well, Tony, the most interesting development is there is a sovereign bond market. You know, a few years ago, nada, zip, nothing. And it took the French government, in fact, making a decision to issue sovereign bonds before we saw any action. I will say they started a little bit of an arms race when it comes to sovereign bonds. The Polish government decided to pick them at the post, quickly made a decision, put it out, issued the first sovereign green bond, while the French were organising a programme. But Agence France Trésor came to market in a studied and careful way and now has by far the largest global green sovereign market with around 40 billion euros of issuance. But we've seen a lot of other ones come to market. Now, you know, the market itself, the broader green bonds market, is exploding. Let's be clear about that. We will see some 80% growth in this year alone. So this is a market that will soon be $2 trillion outstanding. It is not, you know, $2 trillion. There's a $100 trillion bond market. We've got a long way to go. The space that we've really got to grow is the sovereign green bond market. There's about 55 trillion of those, and there's only 120 billion odd sovereign green bonds so far. So you can see that the growth opportunity is in the sovereign space, but it's a late starter. It really only started a few short years ago, and now we're seeing issuance everywhere around the world. You know, so the fact that it exists and is growing so fast is the exciting part of it. It gives opportunities for investors that simply were not there before to be able to realign their portfolio, and it gets governments starting to realise the attention they get by talking about, by showing off the investments that are relevant to addressing climate change and embolden them to do more. And I can tell you lots of stories of individual governments after the Green Bond Program have got excited. The Ministry of Finance starts organising meetings of other ministries and you get pressure to do more. Exactly what we need.
So what can you tell us about the role of individual governments in green bond issuance?
Well, I mean, I've already talked about the French government, and, you know, full credit to them. They've been fleshing out a yield curve. They've been doing demonstration issuance, and also they've discovered, much to their surprise, because this is not why they did it, reaping rewards for French Treasury in terms of bringing in new investors and so on. So each Treasury around the world has a similar approach. There's the benefits to grow the green bond market, the private market, pour encourager les autres, if you like, but there's also the benefits to their scheme of signalling what the government is doing to investors, increasing their investor engagement as a result of that, and also telling citizens. You know, when the Dutch government, the Netherlands government, issued their green bond, where most of the proceeds went to coastal protection, you thought, that makes a lot of sense, but it was fantastic they did that and drew attention to the work that they're actually doing. Now, that's applying everywhere. When Fiji did its 2 green bonds, it was about drawing attention to the adaptation challenges of a small island state. It worked. They got media coverage right around the world, very important, with some consequent benefits for the Fijian government in terms of their relations with donors and other countries. You know, in that sense, it's a communication to the rest of the world device, and it's really working that way.
Thanks very much. That's very interesting in terms of the individual governments. What role does the EU or the European Commission have to play in terms of these issuances, and what can you tell us about the European Commission action plan to which the Climate Bonds Initiative has contributed?
Well, what we try to do in Europe, if you like, is to first embed within the structure, the fabric of the European Union, a whole range of measures that will promote private finance, mobilisation of capital for climate action. The European Union's program is part of that. Of course, it's linked to the Resilience and Recovery Fund. I want to stress, by the way, that European national sovereign issuers are still the leaders in the space. Not only do we have France and Netherlands and Germany, we also have Italy, we have Spain coming to market soon, Slovenia's recently issued, and Poland and Lithuania I've mentioned. So bear that in mind. This is background knowledge. And that's set off a whole train around the world of other issuance from Chile to Thailand. The European Green Bonds program is notable for 2 reasons. One is its scale. 225 billion euros of issuance expected alone in that program over the next 2 years will be a massive fillip to the liquidity of the market and to the ability of major investors to be able to populate their portfolios. You know, we've got a problem at the moment, which is actually supply, not demand. But the second thing that it does is highlights what Europe is doing. In the Resilience and Recovery Fund, which is a 750 billion program of building back better investments, we have 2 very important features. The whole fund is meant to address resilience. Member states are asked to make proposals around resilience, and a third of that goes specifically to green investments that are addressing mitigation as well. Like, this is huge, and the Green Bond program draws attention to it. So it's going to be important. But, you know, Tony, I suppose I should mention something else, which is the euro has not been succeeding in becoming a world currency in the way we thought it would be the last few years. We're now going to get a large slab of European AAA issuance into the market, backed by all member states, which will provide a new opportunity for investors to diversify their currency exposures. And that will lead, you know, to be quite honest, that will lead to an increased profile for the euro as a world currency, with the really exciting part led by green. Now that is a symbolic measure.
Great. What are the main drivers of growth, according to you? What are the main drivers of growth as we look ahead? What signals are the European Commission and individual governments sending out to the markets? What can we anticipate?
Well, the European Action Plan on Sustainable Finance version 2 that was announced a couple of days ago in Brussels has a whole range of measures, including a new European Green Bond Standard, which builds on the existing market standards like Green Bond Principles and Climate Bond Standard, but codifies it for Europe. Very useful. A lot of countries are now doing this. China has done this. We have the ASEAN regulators and central banks doing this, who put out already green bond guidelines, and there are other measures they're taking. You know, in the context of this year's increased commitments to addressing climate change, think of all the 2030 commitments that came out of the Biden Climate Summit in April, with Europe being the first to the table and leading the charge, with 55% cut in emissions by 2030 being the official target now in Europe. We have a lot of stuff that's needing to happen. Governments are moving to grow investments and to support the mobilisation of private capital and to fund a lot of that with, hey, green sovereigns. So you're going to see a lot more issuance on the back of this broad range of measures that key governments are now taking to shift their economies towards clean and green. It's absolutely a central part of this whole change, which is why investing in a green bond, I think, is actually a critical part of being part of the change.
Sean Kidney, thank you very much. You can put your questions to Sean Kidney in the chat box underneath the YouTube screen now. You have to sign in. If you don't want to sign in, you can send your questions through to me on my email, tony.todd@rumeurpublique.fr. Please go ahead and send those questions. I'll put them to all the speakers at the end of this press conference. I'd like to hand over now to François Millet. François is head of ETF Strategy, ESG and Innovation at Lyxor Asset Management. From an investor perspective, François, what's going on in terms of the change of attitude of investors, a change of attitude that is driving a growth in the green bond market? Is there a real, genuine drive towards net zero? Are the investors really committed to this?
Yes, Tony, for sure. But let's start first with the role of these sovereign green bonds in their portfolios, if you will. There was a gap in the market. If we can look at slide number 8, we are focusing on this slide not on the size of the market, but on the growth of the market. There was a gap to the extent that sovereign bonds represent some 54% of any investor portfolio, because this is the weight of sovereign bonds in the global aggregate index. And until 2016, there was absolutely zero in terms of green sovereign bonds for doing portfolio allocation for investors and for asset allocators. So there was certainly a sort of missing link there, which has been now fulfilled. And if we look at the growth of the market, especially what happened over the last 2 years, is essential. We are not talking about France alone anymore. We are talking of a market where 30% of the outstanding sovereign bonds today have been issued this year. This is amazing. 6 months ago, we could not have launched this ETF yet because we were not meeting the diversification ratio of UCITS ETF regulation, for example, and now we are comfortable with that because there is a multiplication of issuers. As we mentioned, there are 37 bonds, 17 countries, so less in the euro area, of course, but Europe is representing 88% or close to 90% of the sovereign green bond issuer. So now there is no excuse for investors. Any investor should have a green bond strategy because they have all the building blocks to do that. The liquid and diversified offer of sovereign bonds was missing, and this is not the case anymore. So this is very important, and this market has close to doubled just over a year. So the change of attitude, yes, there is certainly a change of attitude from investors in two ways. First, in the portfolio objectives, on top of the return-seeking objectives and the ESG criteria, like screening their carbon intensities and so on and so forth, they are now looking at aligning their portfolio. So it's a different concept. They are looking for committing to a certain level of temperature scenario, like 1.5 degree with no limited overshoot, for example, and they are looking for committing to net zero and showing that they are demonstrating that they are restructuring their portfolios to meet this alignment target. So these objectives of alignment are new objectives. And the second change of attitude from investors is that there is an ever-growing request for traceability And in that way, the green bonds, which are providing information on the use of proceeds, but also on impact reporting, are essential, because investors want not only sort of principle of double materiality, measure how the climate change is impacting their portfolio, but they want also to demonstrate how their portfolio is impacting climate change. This is very important. And now they are looking for impact metrics, and they are pushed to that also by the regulation. If you just look at the new SFDR regulation for investment managers, as an example, in the next stage of the SFDR regulation, we will be supposed as investment managers to report the green share of all our portfolios and the green share of the investment management company as well, all together. And we will be also required to provide the percentage of electricity in our portfolio which is from a renewable origin. So this will be a compulsory obligation. So we see that the regulation requirements are themselves pushing investors to seek for more traceability, more understanding of what is done with their money and how it is impacting the world. And from that perspective, new indicators like how many tons of CO2 are avoided by your portfolio over 1 year of holding, for example, which are not carbon intensity indicators, but impact indicators are spreading more and more. And this is something that we can do when we are managing a green bond portfolio, which is much more difficult to report when we are managing an equity portfolio, for example, or even simply a corporate ESG portfolio. So this is a very clear change of attitude that we are seeing on this slide. We are seeing that something like close to 90% of green bonds in the market, accounted in outstanding amount, are reporting regularly the use of proceeds, and something like 75% of the outstanding green bonds are reporting impact metrics, which are effectively very much searched by investors.
Who are these investors? Where are they? What insights can you give us into the terms, in terms of the investor type, the regions, where they are, who they are?
Yeah, so we should distinguish investors in the primary market, of course, like in the big issuances of sovereign green bonds, and issuers and investors, in listed products like an ETF, which is obviously widening the audience of potential green bond investors. So if we have a look at slide 9, for example, it's an illustration based on the 2 latest large sovereign green bond issues, the German one. So this was the 4th German green bond issue for Germany. This is a 30-year green bond. It was, well, massively oversubscribed. We are talking about an order book of 40 billion for an allocation in the end of 6 billion, so massive oversubscription, more than 6 times. For the France OAT Vert, which was the 2nd green bond, but the inaugural one for this maturity, that's the same order of magnitude. It collected something like 35 billion in the order book. So this shows how much appetite we have in these green bonds. Italy is, of course, missing there. Italy has issued, in fact, the largest single green bond issuance, and that was in March. And Italy has collected 80 billion euros of demand for an allotment of 8 billion. So it was close to 10 times oversubscribed. So this shows that there is a very, very strong appetite. And if you look at the example of the German issue on the left-hand side, you see that it was even priced at a slight greenium, so a slight concession on yield to maturity, or something like 2 basis points. It depends, of course, of the issuances. And in spite of that, and in spite of the long maturity, and in spite at that time of the fears about rising rates, there was an extremely strong demand from investors. So yes, the primary market is showing that the demand is absolutely strong. We see regionally that, of course, the home market is important, but UK investors have been some of the largest investors, both in the German green bond issuance and the French one on the right-hand side. So that's an interesting feature. And generally speaking, we have biggest demand coming from a French-speaking area, from the UK and from Germany. And for the ETF, it's a bit different, as you can see on the following page, because ETFs, by definition, are allowing market access to categories of investors which are not allowed to put orders in the book building of primary issuances. So you will in particular see on the left-hand side that ETFs are widening the audience to private banks, wealth managers for discretionary portfolio managers, even retail can buy, of course, green bonds directly. But generally speaking, we have a big chunk going to asset managers, like for the primary issuances. And we see also a lot of asset owners in our own definition, which is in the pension fund, dark blue area here. It's pension fund, but it's also, for example, family offices and various kind of asset owners. But ETFs, it's a bit different structure. And geographically, the ETF demand that we can track because we have the experience at Lyxor is the demand is coming essentially from the French-speaking area. It's close to 40%. From Germany, it's 21%. Italy, 23%. So very strong demand from Italy in 2021 and in 2020 as well. So this is demand on an existing green bond ETF or existing green bond ETFs, so several of them, which are global ones. So we're not talking about sovereign ones, but that gives an idea or a pretty good picture of who are the buyers for the ETF market.
Thanks very much, Francois. You mentioned just now the greenium. There's been a lot of debate in recent years about the greenium, the premium that investors pay on green products. Does the greenium for you, does it actually exist? And if so, why would investors want to pay a premium on a product just because it's green?
Well, actually, CBI has been doing studies half yearly about the issue of greenium, and up until the beginning of last year, the conclusion was that there was no evidence that the greenium was really significant. It was sort of immaterial, and things have changed over the second half of 2020, where we see more and more greenium materializing in the primary pricing of green bond issuances. And we are also, by the way, tracking this greenium in the secondary market because we, as index, so passive managers, we purchase large baskets of green bonds, but we only step in the secondary market because we need to have these bonds analyzed green before they are entering the indexes. So we do not participate to primary book building. So the change was that whether we look at euro-denominated or dollar-denominated green bond issuances over the second half of 2020, a larger proportion of the issuances were priced with a concession that was accepted by investors on the yield to maturity of a couple basis points, which was something quite different from what we observed in the past. So there are many studies about that, and I'm sure that there will be a lot of scrutiny about this greenium phenomenon. But if you look at these charts that we have on slide 12, on the left-hand side, so you have the example of the 10-year green bond issue of September 2020 from Germany. So it was priced like something 1.5 to 2 basis points below the yield of the equivalent non-green bond of same maturity, which is really like-for-like comparable because, again, we have a twin bond structure. And we see that this greenium has even amplified in the aftermarket, so the 3 months following the placement until the end of the year. And on the right-hand side, so we see on a couple of important recent German issues. So again, the 10 years one and the 30 years one, so the most recent one, the other we have mentioned, we see that the greenium has had a tendency to be increasing for the gray area. So the gray area is corresponding, to the short green bond. So it's a bubble. It's a 5 years one. So we see that from inception, it was issued in November. Actually, the greenium has amplified to something like 3 basis points, which is 3-4 basis points, which is significant. For the other one, the 10 years one, the August 2031, which is 10 years, the one we mentioned before, the greenium has been stable over the year 2021. So yes, there seems to be a tendency for these big sovereign issuances to keep a premium in the secondary market. But if you look at the bottom, the example of the European Investment Bank, the blue points are the vanilla bonds of the EIB, and the example of EIB is good because it has a very liquid curve with many issuances. So the blue dots are vanilla bonds. The orange dots are the existing green bonds. So you see that the yield to maturity is not necessarily lower than the curve of the vanilla bond. It seems actually to be slightly higher. So there is no evidence of a greenium there in the secondary market. And if you look at the green issuance that on the right-hand side, it's been priced right on the trend of the vanilla bond curve, so there was no evidence that for primary transactions there was agreement. So it depends, and there is no compelling evidence that there is a greenium which is higher in the secondary market when an index product is buying the green bonds than it is in the primary market, for example. And just to finish, why investors would be accepting to have some basis points of concession on the yield to maturity? Certainly because these bonds are fulfilling what I would refer to as a sort of additional utility function in their portfolio, which is to help them or to support their own statements or their own alignment to net zero, which they cannot do with other kind of instruments. So it's an essential added value of a green bonds in a portfolio. So when you look at the explosion of the size of the market with the previous slide on the growth, any investor now should have a green bond strategy within a fixed income allocation.
Okay, thank you very much for your insight there, Francois. Francois, just to conclude with you, you're head of ETF Strategy, ESG and Innovation at Lyxor. ESG ETFs showed record growth last year. What have you seen this year? What's the role of ETFs in the transition to a greener economy, a greener future?
So what's happening in the ETF market? So you know that the ETF market is the fastest growing segment of the investment management industry for several years. And what's happening in terms of flows to ESG is not a trend, it's a transformation. The market. It's more than a trend. So, for example, talking about the global market and not only ESG ETF, this year to date, the market has raised already 94 billion euros. It's already more than last year. And if we continue on this trend, it will beat the absolute record, which was year 2019, which was 102 before the end of the summer. So it's a crazy trend we see in the European ETF market. And out of that, what we are seeing in this chart is that ESG ETFs are playing a very, very important role as a driver of further growth for the ETF market, but also of transformation of existing vanilla portfolios into ETF-oriented product. Last year, 55% of the net new assets were going to ESG ETFs in the European ETF market. And this year, this is again 45% of the net new assets, of the net inflows, which means that 42 billion euros just poured into ESG ETFs, which have an explicit ESG investment objectives, which are either doing best-in-class screening based on the ESG rating, or thematic investing like water, new energy, and so on and so forth, or green bond ETFs, for example. So the reason for that, I mean, the role of ETFs is actually, as we mentioned, to provide market access, so to democratize access to the green bond market. It's to provide immediate diversification. Of course, you put a simple order with our existing global ETF, you are already holding 450 different bonds which are physically invested by the fund. And you are also access to the wealth of market intelligence of CBI, which is contributing to screening and qualify bonds as green bonds according to its taxonomy criteria and climate bond standards. And these bonds are therefore after selected by the index provider to be included in the index. So you have access to all this richness of data through a simple instrument for a management fee of 0.2% per year. So it's still I would say a relatively low cost way to invest in a fund for green bonds. So this is what the role of ETFs can be to provide another. And I'm also forgetting maybe another function, which is to provide an additional layer of liquidity, because on top of the direct liquidity you have on the green bond market, you have the liquidity which is starting to build up itself on the ETF when it is becoming bigger. So where you have bid-offer spreads, which are getting narrower and narrower, which was the case. So it's also another function of the ETF.
Francois Millet, thank you very much indeed. Just a reminder that you can post your questions on the chat box next to the YouTube window, or you can send your questions directly to me, tony.todd@rumeurpublique.fr. We'll put these questions to the speakers at the end of the press conference. Going to move over now to Philippe Bache. Philippe is head of a fixed income ETF product at Lyxor Asset Management. Hi, Philippe. What has been Lyxor's response to these developments in terms of product? What does Lyxor bring to the market for its clients?
Well, thank you very much, Tony. First of all, again, good morning to all our guests, and thank you very much for attending this event. It is my pleasure to be there this morning and take part in this very exciting launch today. So if we can look at the first slide on screen, please, we can have a look actually at the broader range of all our green bond products, which will elaborate on our response historically. So in our current range, we actually offer three possibilities to take positions on green bonds. First possibility, using our pioneer product, CLIM, the first green bond ETF, which was launched in 2017, and now totals more than 570 million euros AUM. This product is usually what we call an aggregate product because it combines exposures to sovereigns, quasi-sovereigns, and corporates in a single product. And by the way, I refer to this product as CLIM. What the names that you see on screen are the trading names of the products. So this is how we usually refer to them at Lyxor. The second product that you see on screen is also an aggregate type of product with ESG screening, which is called XCO2, and it will exclude some controversial activities. Finally, at the bottom of the screen, what you see on the screen, the third product, which we are launching this week, is specifically dedicated to sovereign issuers of the Eurozone, in response to this booming market of sovereign green bonds, and in order to support investors' net zero carbon objectives. So this product will actually perform several achievements in a fixed income portfolio, given its characteristics. First of all, this product can be used as an investment tool for a net zero strategy adapted to the government bond exposure of a fixed income portfolio. Second, given the nature of the green bond market, which is more long-term than the standard market, the rates exposure of this portfolio will be greater than the typical rates exposure of a standard or maturity Eurozone government bond exposure. Finally, the sovereign green bonds offer use of proceeds dedicated reportings, allocation and impact reports, which allow for the traceability in the sovereigns market, which is a new feature.
Thanks very much, Philippe. But what's the index for these sovereign bonds? How does the index work? What does it look like? What does it feel like?
Yes, absolutely. So to answer your question, we will see on screen a slide that will describe. So first of all, before we enter into the answer, first bear in mind that the sovereign green bond product that we are launching this week is a passive management product. So it's tracking an index. This index is provided by Solactive. So let's now look at how this index is built. As you can see on screen, the process starts with all eligible green bonds on the left-hand side. The blue circle represents all green bonds issued by a member of the Eurozone and aligned with CBI criteria. Then, after some governance filters that are applied, in red on screen, the index methodology will apply liquidity, quality, and maturity filters that you see in dark blue on screen in order to retain only the euro-denominated bonds of the universe with more than 300 million euros outstanding amount and maturity greater than 1 year. This leads to the final index composition on the right-hand side, represented by the blue circle that you see on screen. Now, let's have a look at what it looks like from the inside. We can please move to the next slide. Thank you. So if we now take a closer look at the current composition of the index, we'll see that the index contains currently 8 bonds issued by 5 Eurozone countries, 2 bonds issued by France, 3 bonds issued by Germany, 1 bond by the Netherlands, 1 bond by Belgium, and finally, currently 1 bond by Ireland. The biggest country that you see on screen, the biggest country in terms of weight in the index is currently France with about 39%. Like we said before, this is the biggest sovereign issuer in the world. And then Germany, who has a lot of ambition in that space, with 23% actually of the weight of the index, which is the second weight in the index. And then finally, you will see the other countries, which are namely, like we said before, Netherlands, Belgium, and Ireland.
Thanks very much. And what can you tell us, Philippe, how does this type of exposure compare to more traditional euro government bond exposures?
Indeed, it's an important question, and we will see that in the slide that will appear on the screen very shortly, because it is very interesting to compare the exposure provided by the Euro Sovereign Green Bond Index with the other traditional Eurozone government bond exposures, whether those are all maturity or maturity buckets. So you will see both on screen. You will see the index that we're talking about, the all maturity exposure, and a couple of buckets. Looking at the country weights, the index is currently overweight to France and Germany with respect to traditional exposures. I'm just saying currently. This could change at some point. In terms of risk profile, the index shows a greater duration than an all maturity typical Eurozone government bond exposure, because the product that we are talking about, the sovereign green bond, has a duration of about 15 versus a standard product that has a duration of around 8 to 9. So it's a different risk profile. There is more duration. Therefore, actually, this is why you see on screen the other columns comparing the sovereign euro government bond exposure to I would say to a 10 to 15-year bucket or a 15-year plus bucket exposure seems to be more appropriate than an all maturity. This is why you see the differences on screen. Therefore, to summarize, the index currently provides most of its exposure to France and Germany with a longer rates exposure than a standard all maturity product, and also more yield, which you could see on the previous slide. Finally, to conclude this comparison with traditional Eurozone government exposure, like we've said before, this product can be a tool for fixed income investor for long-term allocation and part of a net zero strategy in the sovereign space. For this purpose, and we will see that on the next screen, on the next slide, please. Thank you. The issuance program frameworks used by all the sovereign issuers have been designed to address very fundamental goals. First, to signal the objectives of the issuing country. For example, using the example of France, it is mentioned in the framework that the objectives of France are to finance the climate change mitigation, climate change adaptation, protection of biodiversity, and finally, reduction of air, soil, and water pollution. So you may actually recognize 4 of the 6 objectives of the EU taxonomy. Second, the issuance program frameworks plan specifically in the framework themselves reporting documents allowing for traceability of the capital allocated to multiple assets and projects. Therefore, there is a very high level of transparency that is provided each year by the governments to explain what types of assets and or projects have been funded with the proceeds of the bond sale, and all that information is available publicly on their internet websites.
Thanks very much indeed, Philippe. And can you tell us, just to conclude, where this product is listed?
Yes, absolutely. We will see that at the summary on the next slide that will appear on screen. This is showing all our range of green bond products, including the aggregate ones that we discussed previously, but we can focus more specifically on the last line, which is the product that we're launching currently, which is called Lyxor Euro Government Bond. It is listed currently on Euronext, and it will be soon listed on Xetra and Borsa Italiana. Thank you very much, Tony.
Thank you very much, Philippe Bache, and also thank you to our other speakers, Sean Kidney of the Climate Bonds Initiative, and also Francois Millet. We're going to go to Q&A now at the end of this press conference. If you have any questions, don't forget that you can send them through to my email, tony.todd@rumeurpublic.fr, or put them in the chat box underneath the YouTube video. So we have a couple that have come in now. First one for you, I think, Philippe Bache. Philippe, is there a different approach between the various sovereigns? For example, what's the difference in approach to sovereign bonds between France and Germany?
Thank you. That's a very interesting question. Actually, yes and no. First of all, the objectives are always the same. The objectives are to finance the strategy for to finance the climate strategy of the country. So in that respect, the objective is to signal the intention of the issuing country to the world. Second of all, to mobilize capital, lead by example, and actually mobilize capital, including in the private sector. So the sovereign issuer will act as a leader for the private sector. So overall, the global strategy is going to be roughly the same. Now, in the details, I would say the financial details of how it works in terms of issuance, there can be some differences. There are, I would say, mainly a difference in the way that they actually issue the bonds, because they don't have necessarily the same objectives. Germany has explained that they have an ambition to establish a reference for green finance in Europe. Therefore, their ambition is also to build a Euro green bond curve by issuing several bonds at several benchmark maturities. So yeah, they actually started with a 10-year, they issued a 5-year, and now they have issued a 30-year. So they have green bubble, green bond, 10 and 30 years. So they have 5, 10, and 30 years. So they are already establishing the beginning of a Euro green bond curve. They are issuing in a very specific way, which is called twin bond concept, because they issue on the same day the green bond and a standard bond on the same day. So it's very specific. And what they usually do is that a standard issuance of bond will be between 20 and 30 billion, and they will issue something like 6 billion, 5 to 6 billion for a green bond. So that's the difference in terms of mechanism and size. If you look at France, the way they do it, they didn't signal their intention formally to build a green curve. But like Sean said before, it was the first sovereign issuer of size. Poland had issued slightly before, but then France issued 7 billion euros on the first day, which was huge. And this issuance of this 2039 maturity bond has grown from 7 billion to today 28 billion, approximately. So they increased the size slightly a few times every year, and now it has grown to be the size of a typical French OAT. So it's comparable. It's 28. Standard size will be something like 30 billion euros. So you can see the two different approaches in that respect.
Thanks very much. And I've got another question, this one for Sean Kidney. This is from Carmen Fernandez from Social Investor, who asks, do you expect a big demand for the coming Spanish green bond? Sean.
Goodness, yes. Goodness, yes. Long awaited. The Spanish government made the announcement a long time ago in 2019. I think that they were planning to do it. Investor demand, we've seen Spanish investor demand, let alone investor demand across all countries in Europe, to be very strong, including, by the way, the UK, where a lot of investors have been buying European sovereign bonds. So, no, I think it will go like water sprayed on a hot tin roof. Zoop, like that.
Okay. Another question has come through. This one for François Millet. François, what is the role of the green bond in portfolio construction?
Yes, sure. So actually, investors, as you know, are now committing to net zero targets. So you have coalitions of investors in impressive amounts which are committing to net zero for 2050. So the Net Zero Alliance, it's 6 trillion. It's 40 asset owners. The Net Zero Investment Manager Alliance, for at this time asset managers, it's even more than that. It's 120 trillion already, so they are committing to net zero, and we are seeing investors who are stating commitments for even sooner than 2050, like Aviva for 2040, or like Swedbank Robur, for example, or like SEB, Investment Management in Sweden, for also 2040. So they need to actually demonstrate that they are starting to reshuffle their portfolios in order to fulfill this own commitment statements. And the green bonds are the perfect instrument of choice to do that, because what they are looking for is they are looking not anymore to improve their carbon footprint based on past data of last year. They are looking for measuring their contribution to the reduction of emissions going forward. Because if you want to demonstrate that you are net zero, you need to commit on a trajectory, and you need to, of course, demonstrate that you are sticking to this roadmap going forward. And for that, green bonds are a very practical instrument, because they are providing you a means to measure your contribution to the reduction of emissions as part of your fixed income portfolio. So this is one of the roles that green bonds can play in a portfolio. Another role is that, of course, investors don't want to be invested in laggards, which are versus their peer competitors in their sectors really lagging in terms of transition, because he perceives that going forward and for the long run, investing in companies which are at the forefront of transition by issuing more green bonds than others, it's a very strong signal that actually they are embedding less carbon liability as a long-term holding, because a lot of fixed income investors are hold to maturity and long-term holder. So it's also good to reweight the proportion of green bonds in your portfolio. And now that you have all the building blocks, including the sovereign, there is no reason for not doing that. So that's also another role that they can play. And if you look also at the sovereign green bonds, to talk more specifically of the topic of this launch, they should fulfill the same ALM, asset liability functions, and as any traditional sovereign bonds. I mean, for banks, in terms of HQLA, so high quality liquid assets for regulatory ratios, they have the same function. In the windows of refinancing as collateral, they can play the same role as well. In the policies of asset purchase program of the central banks, the ECB is already holding 20% of eligible green bonds to its program. They can play the same role as well. So they are totally equivalent to other sovereign bonds. So the question is not why should I buy a green one, is more why shouldn't I buy a green one when I have an allocation to sovereign bonds, for example. So that's also the role of green bonds.
Thanks very much, Francois. Very interesting. Sean Kidney, we've had a follow-up question to the one that we put to you earlier about the coming Spanish green bond. And the question is, similarly, are we likely to see the same kind of demand for the UK's inaugural green bond as we did for France, Germany and Italy?
Tony, or Carmen, I should say, thank you for the friendly questions. I mean, what am I going to say? Of course. We think the demand will be massive. Someone from a central bank asked me last year, if we had as much supply as we wanted of these bonds, what could we place this week? My view is we could place $10 trillion or 10 trillion euros, for that matter, of bonds quickly. The demand is that strong. And certainly, I have every expectation that the UK government's program, which is 15 billion sterling, will go down very well. As will the other issuances that are coming out of it. At the other end of the credit rating range, we're going to see Romania come to the market and Serbia as well. So, there's variety. The question really, which is what one investor in Sweden said to me recently, is if a government is not doing a green bond, what's going on? What's wrong? Have they got nothing to say?
Thanks very much, Sean. Another question has come through, this one again for you, I think, because you mentioned in your presentation at the beginning the European Commission's Next Generation plan that's going to be a big driver for growth. And the question is, what impact do you expect this to have on the green bond market generally, looking forward in 1, 2, maybe 5 years from now? What's going to be the impact of the European Commission's Next Generation plan on the green bond market in the future?
Well, there's two kinds of impact. Obviously, there's the bond aspect, which I talked about earlier, and Philippe and Francois can tell us about what happens when you throw in a vast dollop of green bonds into an existing market and increase scale, liquidity, excitement, energy. Hey, that's going to be enough of a driver in its own right. But the more substantial point here is what European countries are doing now around infrastructure and resilience. Now, it's not uniform. There is work to be done. Member state plans have not yet caught up with the European Commission's 2030 target of 55% cut in emissions. There's still a lot of work to be done. But the resilience and recovery, the Next Generation Fund, is in line with what we want to do. I mean, it is a resilience and recovery fund. Building back better, not building back for the past, is a key theme in the European thinking around this. What that'll mean? A lot more assets, a lot more investments, private sector work on the back of all of that, a lot more green bonds across the board will be an impact of that particular fund.
Thank you very much, Sean, and thank you very much, Philippe and Francois, for sharing your thoughts with us today. And of course, thanks everyone who's tuned in for tuning in, and thanks for the questions that you sent through. If you have any further questions or if you want any more information, don't hesitate to drop me a line, tony.todd@rumeurpublique.fr, and we will get back to you. Thank you very much. We look forward to seeing you again very soon, and have a great day.
Thank you.
Thank you all.